Most captives, whether based in Bermuda or globally, have fixed income securities as the majority of their investment portfolio, with smaller allocations to equity and possibly even alternatives. To understand the rationale behind this approach, it's worthwhile taking a quick look at the investment objectives of a captive's investment portfolio. The primary objective is to support the captive business and pay claims when due. In order to do this, capital preservation and liquidity are key priorities for an investment portfolio of a captive. A second objective of the investment portfolio is to maximize return at the same time. So overall, the ultimate goal is to balance these competing objectives. The asset allocation of a captive is based on the two largest components of the balance sheet: net reserves and surplus, which is the excess capital. Typically, a captive would want high-grade, investment-grade, fixed income to support the reserves on the balance sheet. This is the best estimate of future liabilities to be paid out. The surplus or excess capital can be supported by non-core fixed income, equities, and possibly alternative investments, which diversify away from the core fixed income portfolio, allow more growth in the portfolio, and capital protection at the same time. High-quality investment-grade fixed income is there to support the reserves because of some of its inherent characteristics. First of all, fixed income, and particularly high-grade fixed income, over the long term has had the lowest volatility of any asset class. Therefore, you have a high confidence in the value of the portfolio from time to time. Secondly, a large part of the U.S. fixed income market is supported by the U.S. government itself, whether it be U.S. Treasuries or mortgage-backed securities. This remains an important backstop to a large component of the fixed income market. Well, since fixed income represents the majority of a captive's investment portfolio, it is important for captives to understand the implications of different interest rate scenarios going forward. And fixed income in a rising rate environment can be a complex proposition. One of the largest risks to a captive's investment portfolio would come from a sharp spike in the short term. This would have the impact of lowering the market value of the bonds on the portfolio of a captive. The downside risk and worst case scenarios of these kind of scenarios should be clearly understood by a captive. On the other hand, if interest rates increase gradually in a measured manner over some time, managers are able to work around this through reinvestment of interest income and compounding over years of time, which would offset any initial capital loss. In these kind of scenarios, having a slightly higher interest rate environment can actually lead to higher returns in the long term than the continued low interest rate that we see now. Well, any search for increase in returns should be taken in the context of increasing risk at the same time. We do advise captives and clients currently against materially adjusting tightly prescribed risk parameters solely to chase returns and increase yields. This is particularly important given what the principal investment objective of a captive is, to simply support the captive. We do see a number of clients at this time taking on extra risk-taking, and we would caution against this. Having said that, increasing return does not need to be overly complex. For example, investing in single A or triple B securities instead of double A or triple A could increase your annual return by 1 to 1.5% a year over the intermediate term. Other corporate securities that we like in the United States are high yield or non-investment grade securities. These are typically more risky. These kind of securities in a strengthening U.S. economy should have sufficient cash flows to meet their bond obligations and should have low default rates going forward. Overall, an asset manager should help its captive client understand the balance between risk and return. An asset manager should help a captive emerge strongly should interest rates spike sharply, but also to reduce the opportunity cost of being too defensively positioned in solely cash and earning nothing. The strategic framework for a captive should be focused on the long term and should be intended to respond to various economic outcomes in a balanced manner.